Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Sarepta Therapeutics.
If you find our talks useful, please consider subscribe, like, and comment underneath. And today we really need to talk about what just happened because 2 days ago, March 26, 2026, the biotech sector saw just an absolutely violent market reversal.
Oh yeah, completely explosive.
Right. I mean, Sarepta skyrocketed almost 35% in a single day.
Yeah, closing near $24 a share. Huge trading volume too.
Exactly. So today, our mission for you listening is to figure out what this means. Is this massive gap up just, temporary speculative spike, or is this a fundamental reset?
Right, like are we looking at a distressed asset turning into a real long-term wealth-building opportunity?
Exactly. Because 35% is not just a gentle bump.
No, not at all. A gap up like that is violent. It bypasses standard limit orders completely. But to really get why the market reacted with such ferocity, we have to look back at the massive hole the company was climbing out of.
Oh, absolutely. I mean, 2025 was, well, to put it mildly, it was catastrophic for them.
Catastrophic is definitely the word. They were dealing with intense safety controversies up to and including, patient deaths.
Which is just devastating.
It is. And this is all surrounding their legacy gene therapy franchise.
Right. And for those of you who might not know, they were heavily focused on Duchenne muscular dystrophy, or DMD.
Yeah, a really severe progressive muscle wasting disease that primarily affects young boys. It's fatal and it's heartbreaking.
And the market basically looked at them and said, you are a one-trick pony.
Pretty much. They were so overly reliant on those DMD treatments that when the safety issues hit, the market perception just went grim.
Because if your one trick fails, right, you have no backup parachute.
Exactly. The institutional investors just fled. To survive the storm, management had to execute this incredibly aggressive financial restructuring.
They had to preserve capital.
Yeah, they laid off more than 1/3 of their entire workforce.
Wow, over 33%. Just gone.
Just to extend their cash runway.
It's, think of it like a sinking ship. You're out in the ocean, taking on water, and you're just throwing precious cargo overboard just to stay afloat.
That's exactly what it was, pure survival mode.
But here's my question, and I think this is what anyone looking at the stock is wondering.
Yeah.
How do you go from that level of desperation firing a third of your staff to suddenly getting this massive institutional accumulation and a 35% spike in less than a year?
Well, we do have to be a little careful with that 35% number.
Okay, why is that?
Because heavy volume doesn't just mean smart money is suddenly buying in. It also means desperate shorts are covering.
Ah, right. A short squeeze.
Yeah. When a company is distressed, a lot of traders will short the stock. They bet millions it'll keep dropping.
But then when a positive catalyst hits,
they panic. They are legally forced to buy shares to cover their positions before they go bankrupt. So a chunk of that 35% explosion is just forced buying.
that is a really crucial distinction for anyone trying to build a position. But, I mean, the catalyst itself was real, right?
Oh, very real. That desperate pivot to preserve cash. It was all about funding a brand new scientific approach.
And this is their new competitive moat.
Exactly. They basically shifted everything toward a proprietary RNA technology platform.
Focusing on two new treatments, right? SRP-1001 and SRP-1003.
Right. 1001 is for FSHD and 1003 is for DM1. These are severe neuromuscular diseases.
And historically, biotech has looked at these specific diseases as basically undruggable.
Undruggable because getting medicine into dense muscle tissue without flooding the liver or kidneys and causing toxic side effects is, well, it's a massive biological challenge.
Right, which was the whole problem with their legacy gene therapies in 2025.
Exactly. But this new RNA platform uses something called the alpha V beta 6 integrin delivery mechanism.
Okay, that is a mouthful.
I know. But the breakthrough here is incredible. It allows for this unprecedented, precise targeting of muscle tissue.
So if I'm understanding this right, the old gene therapies are almost like carpet bombing?
Yeah, that's a good way to put it.
You're just dropping a payload and hoping enough of it hits the right cells. But you cause all this collateral damage, which is the toxicity.
Right.
But this new integrin delivery mechanism, it's more like a laser-guided drone delivery.
Exactly.
You're dropping the exact package directly into the specific muscle tissue and ignoring everything else.
Which is why the clinical numbers we saw this week are just jaw-dropping.
Tell me about those numbers, because this is what triggered the massive rally.
So recent phase 1 and 2 data showed a profound biological effect. We're talking about a 90% reduction of the target protein.
Wait, 90%?
90% after just a single dose. And crucially, no dose-limiting toxicity.
That is insane. Where are their competitors at?
Other companies are stuck in the 50 to 60% range.
Wow. So 90% isn't just a statistical win. For a patient, that's life-changing.
It's effectively unlocking treatments that were impossible a year ago.
Okay, but here's where I have to play devil's advocate for you listening.
Go for it.
If this technology is that good, and a 90% knockdown is essentially a silver bullet, why isn't Wall Street universally on board? I mean, we've got heavy trading volume, institutions are buying the breakout, but analyst sentiment is completely fractured.
Oh, it's a classic wall of worry.
Yeah, explain that for our listeners.
Yeah.
Because despite the euphoric price action, we've got a massive wall of worry for this stock to climb.
A wall of worry happens when a stock price climbs despite negative sentiment or skepticism. And the quantitative sentiment scoring right now shows a stark divergence among the major banks.
It's total whiplash. Look at Morgan Stanley. They acknowledge the strong clinical results, right?
Yeah, they raised their price target from $20 to $25.
But they maintained an equal weight rating.
Right, which means they're hedging. They see the 90% efficacy, but they aren't willing to stick their necks out and say buy.
And then you go to the extreme bearish side. Citigroup.
Citigroup maintained a sell rating.
Which is wild. I mean, sure, they raised their target from $9 to $13, but $13 represents massive downside from the $24 it's trading at right now.
Even Seeking Alpha sentiment remains super cautious. They literally said it is too early to get excited.
But why? I guess I really want to push back here. If the technology is genuinely a best-in-class mode, why is Citigroup valuing them at roughly half their current trading price?
It comes down to market memory.
How do you mean?
Well, how do you reconcile massive retail and institutional FOMO with lingering analyst skepticism? It's rooted entirely in clinical execution risk.
The ghosts of 2025.
Exactly. The company has a phenomenal new engine, but those 2025 safety issues mean the market is demanding absolutely flawless execution.
So they don't trust the management team to not mess it up again.
Wall Street analysts have long memories, especially when their reputations are on the line. They remember slapping buy ratings on Sarepta before the safety events blew up.
So it's not about the biology failing today, it's the trauma from yesterday.
Right. And you have to remember how volatile this sector is. Look at Wave Life Sciences.
Oh, right, their competitor. That's a great cautionary tale.
They had weak clinical data recently, and the stock was just instantly crushed. It shows that early phase 1 and 2 success does not guarantee phase 3 victory.
Right, because phase 1 and 2 are small. They measure basic safety.
The phase 3 is massive, hundreds of patients. If any rare toxicity pops up there, the stock tanks.
Which brings us to the catalyst calendar. For investors managing their wealth horizon, what do we need to watch over the next 3 to 12 months?
The first major hurdle is the Q1 2026 earnings.
To see the cash burn rate post-layoffs.
Exactly. Did firing a third of the staff actually save enough capital to fund these new trials?
Because if it didn't, they'll have to dilute the stock to raise money.
Right. And then the company promised more substantive updates later this year regarding the clinical data.
Those are going to be immediate price catalysts.
Highly volatile ones.
But let's look at the ultimate horizon. The overall bullish score we're tracking is a 7 out of 10.
Framing it as a long-term buy for a 12 to 24-month horizon.
But that entirely hinges on successfully initiating the pivotal studies in 2027.
Right.
But 2027, I mean, come on, that is an absolute eternity in the stock market.
It really is.
So how should growth investors manage their risk and, honestly, their psychology while they wait? There's a high likelihood of a sharp pullback if any of these short-term updates disappoint.
Position sizing is everything. You have to accept the short-term volatility as the cost of admission. You don't bet the farm on it because of that binary clinical risk.
So you size it so a 20% drop next month doesn't shake you out of your conviction before 2027 even gets here.
Exactly.
Okay, let's synthesize this core tension for you listening today. Sarepta has successfully engineered this high-reward pivot. They went from a distressed gene therapy story to a diversified RNA platform powerhouse.
Within 90% disease target knockdown.
Right, but they're doing so under a microscope of intense market skepticism.
Battling their own past.
Which leaves us with a final, I think, really provocative thought to mull over.
What's that?
This concept of market memory. Think about how long a company's past failure, like those 2025 controversies, can artificially drag down its future valuation.
Even when the underlying math and technology completely change.
Exactly. And I'd ask you, the listener, to consider if this wall of worry is actually the exact mechanism that creates a lucrative entry point.
Oh, that's interesting.
Right. If traditional Wall Street banks are too paralyzed by reputational fear to properly value this breakthrough, who fills the void?
It forces a massive shift in capital allocation.
Exactly. Does the future of funding shift to, say, AI-driven VC funds or massive patient advocacy groups who only care about the biological math and not the reputational baggage?
Because inefficiency is often the catalyst for total disruption.
Perfectly said. Thank you all so much for joining us to build your financial acumen today. We will see you on the next one.